as the price of Bitcoin surges past its previous 18-week high and smashes through a price target of $21,500, the entire cryptocurrency community has reason to rejoice and be happy. Everyone, that is, except for the people that have lost $300 million as their short positions were liquidated. If you're sitting here thinking, what even is a short position, and how on earth can people still be losing money in crypto even when the price is going up, then you're definitely going to want to watch today's video. Hey everyone, and welcome back. This is the Part-Time Economist, and in today's video we are talking about cryptocurrency, short positions, really cool topics, but I want to tell you this video is not financial advice. I'm simply explaining some of the terms that you may hear in the news so that hopefully they make more sense to you. Please do not make any kind of investing decisions on today's video. Also, if you could like the video, share it, comment, subscribe, it totally helps the channel out and I do appreciate it. So let's start off with good news. If you are like 99% of investors, you are happy that the price of Bitcoin is going up because the vast majority of investors buy and hold. How many times have you heard someone tell you to buy low and sell high? That's what the majority of people do. They buy an asset, they hope the price goes up so they can make a profit. But there's always going to be those pessimists out there. The people that think gloom and doom is on the horizon. They might say, yeah, Bitcoin is cool, but the government is going to ban it and the price is going to go to like 10 cents per coin. Or if we're using a traditional example, yeah, this company is a really good company, but I know that CEO, he is up to no good and he is going to run it into the ground. Get out while you can, right? How do I make money if I think the price is going to go down? What I do is I flip that traditional investing decision. Instead of buying low and selling high, I sell high and then I buy low. But how does that actually work? Well, let's use the example of Bitcoin. Let's suppose that I think Bitcoin is going to crash in price. I would want to borrow a Bitcoin from someone and immediately sell it. So let's just pretend the price of Bitcoin is $15,000. I think it's going lower. I borrow one Bitcoin from someone. I immediately sell it. I've got this nice pile of cash for $15,000. And I still owe someone one Bitcoin though. So let's suppose the price of Bitcoin goes to $14,000. I'm feeling pretty good. $13,000 is better. $12,000 is nice. If we can get down to $5,000, I am one happy camper. Because here's what I'm going to do. I'm going to take that $15,000 that I have and I'm going to say, you know what? I owe someone a Bitcoin, but it's only $5,000. I owe them one Bitcoin regardless of what the price is. I'm going to buy a Bitcoin for $5,000. I'll give them back their Bitcoin. My debts are repaid and I've got $10,000 of profit. So when you short, you get the full price of the asset when you sell it, but you owe that person the assets. You've got to go back and buy it in the market. Essentially with shorting, the lower the price goes, the more profit you make, which is good when the price declines. But let's change the example a little bit. Let's suppose that the price of Bitcoin goes to $16,000. Remember, I owe somebody one Bitcoin. I don't owe them $15,000 worth of Bitcoin, right? I owe them a full Bitcoin. But now that the price is $16,000, my $15,000 is only going to buy maybe 0.9 Bitcoin, right? So I'm going to have to dig into my personal account and come up with an additional $1,000 to get that full Bitcoin that I owe someone. If it goes up to $30,000, well, now I'm going to have to come up with $15,000 on top of my original 15. The higher the price goes, the worse I get. And that is why shorting is so risky. If you're a traditional investor and you put $10 million into Bitcoin and it goes to zero, you've lost $10 million. If you put in $5, you've lost $5. When you short, your potential loss is unlimited because think about it, there's no theoretical limit to how high Bitcoin or a stock could go, right? So shorting is typically very risky. In the traditional brokerage world, You have to go through an application process. You have to get approved for it. Most brokerages won't just let you short however you feel like it. The crypto markets are a little bit less regulated. Each crypto market kind of develops its own rules, its house policy, stuff like that. So I'm going to give you a general example. If you're doing this for real, you're going to want to obviously familiarize yourself very well with the policies of your specific crypto exchange. But let me just give you an example. Let's suppose that we have the Part-Time Economist crypto derivatives exchange, and I want to short one Bitcoin. Well, they're going to let me borrow my Bitcoin. I sell it for $15,000, and there's going to be some kind of ratio, some kind of equity that I've got to keep. Again, this is going to depend on the crypto exchange, but let's just suppose that the Part-Time Economist derivatives crypto exchange, they say, hey, we know that the price is going to move up and down. We're going to let you only have a 10% deviation, right? So I short Bitcoin. Let's suppose, again, just to make the numbers easy, I short it at 10,000. The price drops down to 9,000. I'm good, right? Because I have more equity than it would cost me to repay my position. 8,000, 7,000. Again, that's all good because I have more cash in my account than it would cost me to go back in and buy back the Bitcoin, right? Now, let's suppose that, again, they give me a 10% and Bitcoin goes up to $10,010, right? I'm still good because I'm still within that margin that they give me for price fluctuation. Let's suppose I do get to that 10,000, I guess, or $11,000 it would be. Now, I don't have enough equity to cover that, right? The firm, the crypto derivatives exchange, they are exposed to that loss, right? So they're going to put limits on me and they're going to say, hey, you need to bring in some more money right now to get your equity back in line. If I can't do that, eventually there's going to be a point where they just sell my positions to cash so that they can repay the position, the person, I should say, that I owe that Bitcoin to, right? And again, that is a very, very, very simple example. But essentially what I want you to understand is when you short something, you have unlimited potential risk. The price could go to infinity. So most exchanges, most lending platforms, they're going to cap you and they're going to say, hey, we know what you're trying to do here. We're totally cool with it, but we're only going to let you get so much out of whack before we just close out your positions. And that's what you're seeing a lot here. As the price of Bitcoin goes up, people might have shorted it at 20,000, at 15,000, whatever. They don't have enough because the exchange is saying, hey, you only have $15,000 in your account and it's going to cost you $16,000 to buy back this Bitcoin. Where's the additional $1,000 coming from? And someone's saying, well, I don't have it. The exchange is saying, well, hey, we're going to just sell what we can, right? So that's kind of what's going on here. Again, very simplistic example, but anytime you hear of a short liquidation, essentially what that means, someone borrowed an asset, they were hoping the price would go lower and the market moved against them. So the exchange is trying to kind of keep things back in balance, right? Because they're not going to let it just go, well, I'm going to wait till Bitcoin goes up to $1 million and hope that it drops back down to 100, right? They're going to cap their losses at some point. So again, not financial advice. I do hope that you found the video useful. I thank you for watching and I'll see you next time.